Welcome to Smart Stock Watch, your go-to channel for in-depth financial analysis. Today is November 10th, 2025, and we're diving into Organon's latest earnings report for the third quarter. Joining us is John, a senior analyst from Smart Stock Watch. John, thanks for being here.
Thank you for having me. Organon, a global healthcare company, has just released its Q3 2025 earnings report. It's an interesting time for the company, especially with the recent leadership changes and strategic focus on women's health and biosimilars.
Revenue and profitability overview. Let's start with the top line. Organon reported a revenue of $1.602 billion for Q3 2025, which is a slight increase from last year. However, the net income saw a significant drop. Can you explain this, John?
Absolutely. While the revenue increased by 1% as reported, the net income fell to $160 million, a 55% decrease from the previous year. This was primarily due to increased cost of sales and one-time costs related to optimizing their manufacturing and supply network. However, on a non-GAAP basis, the adjusted EPS was $1.01, beating the forecasted 90, and the adjusted EBITDA margin improved to 32.3%.
Segment performance and strategic initiatives. Organon's diverse portfolio is a key strength. How did their different segments perform this quarter?
Women's health revenue declined by 3%, mainly due to decreased demand for Nexplanon in the U.S. However, biosimilars saw a robust 19% growth, driven by strong performance from Hadlima and new product contributions like Bildios and Bilprevda. Established brands also held steady, with a slight increase in revenue.
It seems like their strategic focus on biosimilars is paying off. What about their new product launches?
Indeed, the new biosimilars like Bildios and Bilprevda, along with Tufidence, are contributing positively. These products are part of Organon's strategy to expand their biosimilars portfolio, which is crucial for their growth in the competitive healthcare market.
Guidance and market outlook. Looking ahead, Organon has adjusted its full-year guidance. What are the key changes, and how should investors interpret them?
Organon has lowered its revenue guidance to a range of $6.2 billion to $6.5 billion, reflecting a more conservative outlook. The adjusted EBITDA margin guidance is also slightly reduced to around 31.0%. Despite these adjustments, they declared a quarterly dividend of 2 cents per share, indicating confidence in their cash flow. However, their debt remains high at $8.83 billion, which is a point of concern.
How do you see these changes affecting their market position?
The lowered guidance suggests caution, possibly due to competitive pressures and economic uncertainties. However, their focus on cost discipline and strategic growth in biosimilars could help mitigate some risks. Investors should watch how these strategies unfold in the coming quarters.
CEO's vision and strategic focus. Interim CEO Joe Morrissey has shared his vision for Organon. What are the key points from his statement?
Joe Morrissey emphasized the company's strengths, particularly in women's health and biosimilars. He expects over $900 million in free cash flow before one-time costs this year. Morrissey also highlighted their commitment to cost discipline and reducing the debt burden, which are crucial for creating balance sheet capacity and pursuing growth opportunities.
It sounds like a focused approach. How critical is this for Organon's future?
Very critical. By leveraging their diverse portfolio and maintaining financial discipline, Organon aims to position itself for sustainable growth. Their strategic focus on impactful medicines and solutions aligns well with their mission and market needs.